Hello guys and welcome to a new deep value video. Today we're going to deep dive into the finances of Analog Devices Incorporated, ticker symbol ADI. Analog Devices is a company operating in the semiconductor industry. As of the 21st of August 2024, its stock price stands at $223 and it has a market cap of 110 billion. Moving on to some key valuation metrics, the company's price to earnings ratio is 29.3 while its price to cash flow ratio is 26. Now, let's take a closer look at the company's growth over the past 5 years. We can see that its revenue has grown by 105.4%, while its bottom line has increased by 143.2%. In terms of earnings per share, there has been a growth of 70%. However, it's important to note the change in the number of common shares outstanding, which stands at 500 million, reflecting a 33% increase. Additionally, the interest coverage ratio is 9.1, suggesting the company's ability to meet its interest obligations comfortably. Next, let's move on to the balance sheet, starting with the quick ratio, which is calculated by dividing current assets minus inventory by current liabilities. We see that it stands at 1.13. This ratio helps us understand the company's short-term liquidity position. Looking at the long-term debt-to-equity ratio, we find it at 0.18, and the overall debt-to-equity ratio, or the total liabilities to equity ratio, at 0.38. Now let's transition to the cash flow statement. Cash from operations is 4.8 billion, reflecting a change over the past 5 years of 113.8%. Meanwhile, cash from investing activities is minus 1.36 billion, showing a change of 332%. Furthermore, cash from financing activities is minus 4.06 billion, reflected and has changed by 91% over the same period. Lastly, free cash flow has grown by 79.7% during the same time, from 1.98 billion to 3.55 billion. It's projected to grow to 4.26 billion in 2025. Moving forward, let's look at the return metrics to see how the company is utilizing its resources. The return on equity is 44.4%, which gives us an idea of the profitability relative to shareholders' equity. The ROI is 6.07%, the ROA is 6.7%, and crucially, the ROIC stands at 8.48%. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis by using a discount rate of 10%, a revenue growth rate of 10% for 10 years, and a perpetuity growth rate of 3.5%. We get a fair value of $161.5. Secondly, using a multiples valuation of 20 times trailing 12 months price to earnings, operating cash flow, and 25 times trailing 12 months free cash flow, we get a fair value of $136.6. Furtherly, the analyst target price is $254.5. Putting it all together, we get an intrinsic value of $184.22. And using a 15% margin of safety, we get an acceptable buy price of $156.6, suggesting that the stock at the current levels is overvalued. To wrap up my analysis, I'd rate ADI as a hold, and if it reaches more than 270 this year, I would rate it as a sell. Personally, I consider investing in it only if its price drops to sub 190 levels, and not because it's a bad business. It's actually a great business with great fundamentals. It's just that I believe the valuation is a bit too high at the moment. Thank you for watching. If you found this video helpful, please like and subscribe for more deep value analysis. See you in the next video. Bye.